All right, welcome to The Explainer. Today we've got a real head-scratcher from Wall Street, and our case study is US Foods. So how on earth does a company post record profits and then watch its stock just tank? It's that age-old story, right? Perfect execution on the inside versus the market's endless hunger for growth.
Okay, so let's just dive right in. Picture this. It's August 7th. US Foods drops its quarterly report, and on paper, it looks amazing. I'm talking record profits, record margins. They even raise their guidance for the rest of the year. But then you look at the market. Oof, a brutal pre-market sell-off. So you have to ask, what in the world did investors see that the C-suite apparently didn't?
And this really is a genuine earnings paradox. The company's results and the market's reaction are telling two completely different tales. So to really get what happened, we've got to look at both sides of this thing. And here's the verdict from the market, a 7.2% drop before the bell even rang. You know, this wasn't some little blip. This was a huge flashing red light, a signal that investors were really nervous, and they just blew right past all those good-looking headlines.
So why the harsh judgment? Well, it all comes down to a split decision, a tug of war between the two numbers every single investor watches, the top line and the bottom line. Let's break it down.
And this right here, this is the whole story in a nutshell. Look, on one hand, you've got profitability. Their adjusted EPS, basically how much profit they make per share. They beat the street's expectations. That's a solid win. But then you look at the other side, growth. Their total revenue? It missed. Yeah, only by about 1%, but in this kind of market, that miss just screamed louder than everything else they got right.
And if you dig in a little deeper, the profit story gets even better. Their Adjusted EBITDA, that's a really key measure of their core profit, hit a record $548 million. Their EBITDA margin, also a record. So management was running this incredibly tight, efficient machine, but all the market could see was that one single revenue miss.
So, how in the world did US Foods pull off these incredible profit numbers? Well, it wasn't an accident. This was a very deliberate strategy, a playbook that was all about focusing on the things the company could actually control.
And you can just hear that focus in the CEO's own words. On the earnings call, Dave Flittman wasn't out there talking about chasing fads. Nope, he was talking about execution, about taking market share, and about driving those record margins. That was the story they wanted everyone to hear.
So they have this self-help strategy, right? It's basically a 4-point attack on being inefficient. They were hammering down costs from suppliers. They were growing this really high-margin delivery service called Pronto. They were even rolling out new tech to make their delivery routes smarter. And to top it all off, they bought back $250 million of their own stock. They were building a fortress of profit from the inside out.
And they are absolutely doubling down on what's working. They're so bullish on that Pronto delivery service that they just hiked its 2027 sales target by 50%, all the way up to $1.5 billion. That's management telling you loud and clear where they see the future profits coming from.
And the strategy just keeps going. They're pushing their own in-house brands to improve profits. They're tackling waste to cut down on inventory losses. They're paying down debt, making the whole company financially stronger. And maybe the most important part? They're proving it all works by gaining market share with those profitable independent restaurants for the 17th quarter in a row.
But all of this fantastic internal work just slammed into a big external wall of worry. Because despite that amazing profit playbook, the market saw some serious cracks in the foundation of the whole economy.
If you want to understand why the market freaked out, this chart is pretty much all you need to see. So you've got healthcare, up almost 5%. Nice. Independent restaurants, up over 2%. Also good. But then you get to chain restaurants, down 4%. Now, the company tried to explain that some of this was intentional, but for an investor, seeing a big negative number in a segment that size just screams one thing: danger. It suggests the average consumer is starting to pull back.
And that brings us to the fundamental question that investors are wrestling with right now. Can a company really just cost-cut its way through a slowing economy? US Foods is proving it can master its own house for sure, but the market is basically betting that a weak macro environment will eventually sink even the best-run ships.
So, you've got this amazing internal profit engine on one side and these big, scary external growth fears on the other. Where do we land? Well, that brings us to the next call.
So here it is, the bull versus the bear. The bulls see this super disciplined company hitting profit records, buying back its own stock, and raising guidance. The bears? They're laser focused on that revenue miss, the drop in chain restaurants, and just a generally shaky industry. It is the classic battle between what a company can control and what the market fears.
So our call for next quarter, we're calling it cautious stability. We think the company's internal playbook is going to keep delivering, which should put a solid floor under their results. But we also think the wider market weakness is going to keep a lid on their revenue growth. A huge breakout just feels unlikely right now.
Which brings us to our final rating, market perform. The company's incredible focus on margins provides a really solid floor for the stock. But until investors see a clear, believable path back to top-line growth, the upside just feels capped. You know, they're doing a fantastic job steering their own ship, but they can't change the weather. And it leaves you wondering, in a market this anxious, is just being good ever really good enough? And as always, a quick but important reminder, this explainer is for informational purposes only. It is not financial advice.